then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Dheeraj Mistry from ICICI Securities. Thank you, and over to you, sir.
Yeah, hi. Good evening, all, and thank you everyone for joining this call. First of all, I would like to thank management of JYOTHYLAB to give this opportunity to host this call. From the management, we have with us Madam Jyothy with us and Mr. Pawan Agarwal, CFO. Over to you, ma'am, for your opening commentary. Thank you.
Thank you. Good evening, everyone. Thank you for joining us for JYOTHYLAB's Q2FY26 earnings call. Our financial results and investor presentation are available on our website and the stock exchanges, and I hope you have had the opportunity to go through them. The operating environment in Q2 was mixed. While the quarter started on a positive note, the GST rate revision announced by the government in September 2025 caused some disruptions in the marketplace. As a result, growth in the September quarter was nearly flat as the distribution network adjusted to the new GST structure. However, the early demand signals are encouraging as we have begun quarter 3. During the quarter, the government implemented a revised GST rate structure for several daily essential categories. For JYOTHYLAB, this included key products within our personal care portfolio, such as toilet soaps and toothpaste, which together account for around 11% of our business. The benefit of lower GST has been fully passed on to the consumers through revised pricing, and the change remains cost neutral for the company. This transition led to temporary disruption across trade channels as distributors and retailers adjusted to the new rate structure and refreshed inventory with revised prices. We continue to believe that a broad-based consumption recovery is underway, aided by supportive fiscal measures, tax rationalization, and stable macroeconomic conditions. We expect the demand environment to strengthen gradually through the second half of the year. Across channels, general trade remains subdued, while modern trade, e-commerce, and quick commerce maintain double-digit growth, led by strong performance in fabric care and dishwash. Let me now turn to the performance of our key segments. In fabric care, both main wash and post wash delivered an encouraging performance. Value growth was 6.1% and volume growth was in high single digits. Liquids more than doubled year on year, driven by strong performance from Henko, Ujala, More Light, and Mr. White. Detergent powders and bars maintained their momentum. New launches made in the past few months have been well received and are delivering sales in line with expectations. We also introduced Dr. Wool, expanding JYOTHYLAB's fabric care portfolio into a premium niche and strengthening its presence in special garment care. The dishwash segment volumes grew 3.4% despite a 3.8% value decline, driven by price corrections and grammage offers on bars. Liquid continued to outperform bars. The performance of personal care segment was impacted by the GST transition in September. We expect the segment to normalize and return to growth in H2. In household insecticides, the growth remained muted as we continue to focus on profitability improvement over the next 4 to 6 quarters. New product formats such as Maxo aerosols and anti-mosquito rackets are showing early traction. The medium-term focus remains on driving efficiency and turning around the category. In summary, despite short-term disruptions from the GST transition, our fundamentals remain strong. Rural demand trends are encouraging, premium segments are expanding, and modern trade and digital channels continue to gain share. We remain confident of delivering steady, broad-based growth in the second half of FY26. Now coming to our financial performance, revenue from operations for Q2 stood at 736 crore, reflecting value growth of 0.4% and volume growth of 2.8% year-on-year. The difference between value and volume growth was primarily due to MRP reductions, higher grammage and promotional price-offs in select categories. Gross margin for the quarter was 48.1%, lower by 210 basis points year-on-year, mainly due to input cost pressure and price reduction and consumer offers in select categories. Sequentially, however, gross margin was protected despite lowering of prices in certain categories. Also, commodity prices saw some signs of stability during the quarter. Employee costs increased by around 5% year-on-year and were maintained at 11.5% of revenue on a sequential basis. Advertisement and promotion spends were at 8.4% of revenue, marginally higher than the same period last year. With expectations of a better sales trajectory, we made a calibrated increase in brand and trade investments during the quarter. Other expenses remained range-bound at around 12% of revenue, supported by cost discipline and operational efficiencies despite subdued market demand. Despite input costs and volume pressures, EBITDA margin was maintained at 16.1%, in line with our earlier guidance. We expect EBITDA margin to remain in the range of 16 to 17% in the second half, assuming commodity prices remain stable and demand continues to improve. Operating EBITDA for Q2 stood at 118 crore and PAT was at 88 crores. For the half year ended 30th September 2025, revenue from operations was a little over rupees 14,187 crore, representing 1% value growth and 3.2% volume growth. Fabric care and dishwash segments delivered mid to high single-digit volume growth during the period. Gross margin for H1 stood at 48% compared to 50.8% in H1 last year, while operating EBITDA margin was 16.3% against 18.4% in the previous year. The effective tax rate for the half year ended was 25% compared to 24.2% of FY25 and is expected to remain in the range of 24 to 25% for FY26. Net working capital stood at 22 days as of 30th September 2025 compared to 19 days as of 31 March 2025. The temporary increase in working capital was due to a shift in channel mix with a larger share of business now coming from modern trade, e-commerce and quick commerce, where credit cycles are longer than in general trade. We expect net working capital to normalize around 18 to 20 days in the medium term. Net cash generations from operations improved to 196.5 crore compared to 188.9 crore last year. With a strong cash balance of rupees 801 crore and zero debt, the company remains well positioned to fund growth and invest in innovation. We remain cautiously optimistic about a gradual improvement in demand and further stability in commodity prices. Our focus remains on profitable and organic growth, strengthening core categories, invest in innovation, and scaling up new product launches. I would like to take this opportunity to thank our teams for their continued commitment, our trade and distribution partners for their support, and our investors for their trust and engagement. We appreciate your time today and look forward to your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will wait for a moment while the question queue assembles. The first question comes from the line of Rishabh Shah from Buggle Rock PMS. Please go ahead.
Hi, thanks for the opportunity. Our first question was we had launched a new beauty soap, Jovia. So I had just a question on that. And a previous soap brand, Margo, was not as successful as we were expecting. So what is your thought process on this new brand? How big can we make Jovia as a brand?
So hi Rishabh. Margo Neem Naturals is the one that you're talking about, and it is doing reasonably well. Now, as we see in Q3, we can see good enough improvements in the brand and in personal care. So Jovia and Margo both put together are delivering for us from Q3 onwards. Yes, the first half was muted, but going forward, both of these brands will start delivering.
Okay. So by when can we expect to have a significant contribution from these brands, like from the next year onwards or from the second half of this year?
See, personal care for us in the first half was muted. Going forward, yes, it should come. The Jovia as a brand is a new brand, so it will take its time, but it's doing fairly well.
And moreover, we have actually made good investment behind Margo franchisee in terms of advertisement spend in this quarter, and those investments are also going to yield good dividend going forward. So both original Neem and Neem Natural are likely to perform better as we go forward.
Okay. Yeah. So my next question was, what in terms of some product category, we have not been as much successful on the national level in some of the product categories. So we have remained in a comfort zone in the southern markets. So what are your future plans to make the products a national brand and let's say expand more in the other than the non-south region of India? And which products of your portfolio can make it?
So actually, the comment that you made that our brands are focused or concentrated in southern India only is not entirely correct, because our revenues from southern India has come down from 40-odd% to 33% over the past few years. So we are expanding our product portfolio to pan-India basis. So that's point number one. Point number two, there are many brands. You can take EXO, you can take Prill, you can take Margo, you can take Ujala also now is expanding and going upwards. So there are many brands which are pan-India, and it would be unfair to categorize us as a southern India-based company and all the brands focused on southern India.
Okay. Thank you. I will join back in the queue.
Thank you. The next question is from the line of Vishal Gutka from ASK Investment Managers. Please go ahead.
Yeah. Hi, madam. 3 questions from my side. First question on the aspiration for revenue growth for second half of FY27. This is in the context that competitive intensity has gone up across segments and HUL also is going very aggressive across categories. So what are your thoughts on that? Secondly, new launches, couple of new launches you have made. First thing is on the wool, and second is Ujala Young and Fresh. So are we expecting to enter more categories because second half has already started? We're yet to see launches. So what is the overall new product launch calendar? And third question on the M&A front, now almost around 800 crore on books, right? So what is the thought process? What is the constraint that is hindering us from making acquisitions? Thank you.
Yeah, Vishal. So second half, yes, it is a very competitive market. But since there are a lot of positive indicators that are there, and also going by what our October sales has been, it looks positive. So I can only comment that we are aiming to be back like how we were in the past. So we are trying to do all that it takes for building our brands and making it, grow at volume-wise double digits. Okay, at least by exit of this year, we should aim at a double-digit volume growth.
Value and volume, sorry to interrupt, value and volume should be similar, or there should be a gap in value and volume growth?
There will be a gap, Vishal, because we have been maintaining that given the market scenario and the average realization being lower, so there will be a gap, and this gap would be different for different categories. But on an overall basis, there will be 2.5% gap.
Okay, okay, sir. Got it, sir. Go ahead, sir. Thank you.
Yeah, and NPDs, Dr. Wool, what you mentioned is a very recent launch. It is specialized garment care, especially for your winter clothes and your delicate fabrics. It is just launched and it has been well received. It will be mostly, selling, especially in the winter months. But there was a gap there in the offerings, and hence we have introduced that. Young and Fresh, yes, we had introduced it early on in this year. It is a fabric conditioner, and it has been also been received reasonably well. So yes, going forward, these are the other two brands that will be, contributing in the fabric care category. Few more NPDs will be there, which you will come to know when we launch it. But all of them in the pipeline. Yeah.
And it will be launched in F26 only, or we are planning to postpone F27?
No, so you will see more launches in this year itself. Of course, there will be some lined up for next year.
Got it. Thank you.
And on your third question on M&A opportunities and the cash balance, so as we have mentioned in the earlier calls also, that we are actively looking for the right asset, and we have explored few of them, and we are in talks with few of the assets, few of the businesses. So as and when it materializes, it will be made known to the streets.
Got it, sir. Wishing you all the best, Jyothy madam and the team. All the best for future products. Thank you.
Thank you.
Thank you. The next question is from the line of Nitin Shakdev from Green Capital Single Family Office. Please go ahead.
Hi, good evening, Jyothy, and to the management. My name is Nitin Shakdev. I'm from the Green Capital Single Family Office. My question is more as an investor rather than an analyst. If I look at the categories which the company, obviously its legacy businesses are in, there are a couple of new brands and upstarts which are coming in with low volume but maybe differentiated products. Now, we just spoke about M&A and the acquisition, but just wanted to get a flavor of the aggressiveness of the management in terms of trying to take over categories from newer players, let's say like Coparo, Clean and all that. And just wanted to get a sense of how the company is envisaging growth, one through organic and inorganic means, because it's obviously sometimes easier or less expensive to take over a brand rather than build a brand from scratch, at least in terms of the premiumization strategy. Just a little flavor on that would be nice. Thank you.
So thanks, Nitin, for this question. It's a classical debate of make or buy. And, as I mentioned, we are looking at assets which actually complement us, and the adjacent categories, and the asset which we are able to, leverage on our strengths. So it will be a combination of all these factors. And we believe that we have huge runway available in terms of our existing categories for organic growth. So in terms of future growth, it will be a combination of both organic and inorganic.
Yeah, I mean, I understand that. But what I was coming to was that more in terms of slightly higher growth than the category of the market, which is consistent, and Jyothy for the many 10, 15 years has been on consistent growth categories. But how does a brand take the leap forward and not risk newer competition coming in and eating in margins? Just, it's a classic case of a investor trying to decode the long-term runway of a company, not so much in terms of analysis or percentages and quarterly margins that the company very well knows. So just sort of a discussion on that.
Yeah, so Nitin, the only way to build any brand for us, quarter-wise is not something that even we are focused. We are more here for the long term. And that's why you see consistent investment, be it ad spends, be it innovations, and the kind of R&D that pipeline that we have developed, and some of the launches that you will see in the coming years is something that we are already preparing. And to say that we actually don't need an acquisition in that sense. We have enough, to grow organically with our current brands and the pipeline that we have. But having said that, to fast track growth and to have even more aggressive this thing is where the acquisitions will help. But yes, we have few things lined up with differentiated offerings, and that should be able to do the fair contribution to in the coming years. So that's what we are expecting, and let's see where it takes us.
Okay, ma'am. All the best, and all the best for Q3 and Q4. Thank you.
Thank you. Thank you so much.
Thank you. The next question is from the line of Umang Shah from Banyan Tree Advisors. Please go ahead.
Hi, ma'am.
Mr. Umang, you are not audible.
Am I audible now?
Yes, sir. Please go ahead.
Okay. Thank you so much. Thank you for the opportunity. Sir, ma'am, wanted to confirm the first thing was only our personal care portfolio is affected by the GST, right? Everything else is no change.
Yes.
Okay. Would it be possible to quantify the GST impact? I mean, if things were normal, what would have been our growth?
No, it's difficult to put a number behind this, but there was a general disruption in terms of channel. The order uptake was significantly dropped, and in fact, at a Kirana store level, they had tax paid stock, so they were reluctant to place order, until their tax paid stock inventory gets liquidated. And then similarly, the distributors were also, so overall, personal care was largely affected because of the GST reduction. In other categories also, although they were not covered by GST, but there was a lot of confusion and chaos in the channel. So the safest thing that they could do is to stop buying and wait for the final situation to get clearer by 22nd September. So as a result, as Jyothy mentioned in her opening remark, this was affected. The business was affected in September.
Got it. So although the category affected was only 11%, but because the same distributor has a lot of confusion with respect to other things also, there was destocking across the segments, not just personal care.
That's correct.
Got it. Thank you. Second question was with respect to making the home insecticide segment profitable. So for more than 3 years, I think the illegal incense sticks have been causing a big damage both to the consumers and to the sector as a whole. At that time, our understanding was that once there's some action on these, we would get back with our coils, and then we were also focusing on liquid vaporizers. Now we are saying that we would want to focus more on profits. So just wanted to understand how would you want to go about it, and as per your internal workings, when is the break-even apparent?
So in HI segment, our stated position is that we are focused on turning around this segment, and we are not intending to lose more money behind coils, and that's a conscious call we have taken. We are focusing our energies, investments on liquid vaporizer, and we have also launched new products, Maxo Aerosol and Anti-Mosquito Racket. See, all these categories are profitable categories, and they are doing good for us. Of course, it's going to take time, and we have indicated that it may take another 4 to 6 quarters for this segment to turn profitable. So that's the time it will take in our assessment.
Got it. Sure. Thank you. And this last question, if I can squeeze in, we have relied on having brand ambassadors for all of our products. And that makes a lot of sense because we have a rural focused distribution of products also. Just wanted to pick your brain on in last 1 year, have we done a different kind of an activation through social media or something, and how have been the results, and going forward, how would you allocate your spends towards digital?
Yeah, so Umang, we have been investing behind digital, medium. while TV is also important for us, being an FMCG company. But we are increasingly, also shifting our budgets towards digital and rural markets also. So if you see some of our products, it depends on the brands that and what priorities we have and which regions, what focus we need to do. And we take those calls accordingly. But the digital spends definitely have increased from what it used to be.
Got it. Thank you so much. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good evening. So just on this volume growth bit, Pawan, you mentioned there is a disruption, and it's not only in soap, it kind of filters out across because of the distributor behavior. But, most companies are calling out like a 2-3% type of a disruption in terms of the growth. Would our number also be in that same ballpark? I just want to understand real volume growth to get a sense of, how to build the gradual improvement to H2. So that's the first question.
So, Harit, as I mentioned, for us, it is very difficult to put a number on the GST disruption. But overall, personal care took the biggest brunt in terms of GST. And in other categories also, there was some impact, but the bigger issue was on personal care.
And this, personal care margin bit, which is the second question, if you look at last quarter, it is a flattish revenue growth and you still did double-digit EBIT. With a deceleration -4%, is the operating deleverage so high that the margin moves as it does? And should this margin move back to normalized level in quarter 3 as the normalized growth starts to resurface?
Very good question, Harit. There are 2-3 points which have led to the margin blip that you see in quarter 2 in personal care. So I mentioned earlier that in this quarter we have made a sizable investment behind Margo brand. So that is kind of one-off item which is there sitting in personal care EBIT margin. Second is the last year in H2, maybe towards November, December, January, the price increases that we had taken in Margo, those price increases have actually impacted the sales subsequently. So you see a lower sales. And thirdly, the input prices, if you look at the farmer prices, quarter 2 was this year versus quarter 2 last year, there is 14-15% increase. So input prices have gone up. So that has also affected. And I can indicate that going forward in a couple of quarters, we will be back to double-digit margin. Some of the actions that we are taking and the investment that we have made, that would help us accelerate our sales growth in personal care, and the margin should swing back to double digits.
Got it. And on the dishwash bit also, the deflation or lower realization or whatever impact you can call it, which is almost like 6-7%, given that volume growth is still pretty good. How much of this is like schemes-led competitive intensity, and how much of it is like actual pricing? Why I'm asking is, how much of this should be kind of extrapolated? I know you've given a overall 2.5% number into H2, which will be deflation, but just on dishwash, how much of it is scheme-led? How much of it is kind of actual price cuts? Just wanted to understand the market.
It will be a mix of both, actually. Again, the bifurcation between scheme and others is difficult for dishwash. The lowering of MRP in certain SKUs in bars and also in liquids, the average realization being lower. That both these factors have actually led to this price decline in dishwash category in the quarter.
Okay, got it. And on the HI bit, I know the season has also been a bit challenging. That is reflective even in in the other companies' numbers. But how much is the mix now in H1 for LV versus coil for our business now? How much has that number gone up? If you could just help us understand that. I get your 4 to 6 quarter thought on break even, but how have we progressed on the LV ratio versus coils? If you could just help us understand that.
Yeah. So LV, I can tell you, LV has surpassed coil. So that's the first milestone we have achieved. Okay. And we are gradually building on. And aerosol and rackets, as I mentioned, they are also falling in the similar category. So we are taking tiny steps and with the objective to turn around the category in 4 to 6 quarters.
Okay, understood. And last point was on distribution. So, H1, have we seen, I know we do talk about 8 to 10% typically in distribution expansion or direct side, but given all these disruptions this time around, etc., has the distribution-led piece been a bit slower? Any sense on the full year? Does it get shifted on to, early part of next year in terms of increasing, touch points on the direct side? Some thought on distribution.
So Harit, distribution for us, yes, we have done quite a bigger part in the last 5 years, and it still continues in the same way. But since the base is higher, just anything additional will look a bit, smaller, but we are continuously investing, or focus is definitely there on increasing the number of outlets. That still remains.
Okay. And Jyothy, one last one maybe to you was, the optimism on closing or exiting F26 on double digit is very, very encouraging. Are you seeing some of these positive triggers already play out? I mean, we are already almost a month and a half into or halfway through this quarter. So does your optimism also stem from what you're already seeing on the ground, and maybe that coupled with maybe the innovation pipeline? Is that the way to think about it?
Yes, definitely. I think we are happy that our new NPDs have been received well. We'll continue to focus on building those brands, and we also have few things in the pipeline, which obviously eventually you'll come to know. But yes, our focus is there on the fabric care category and on other categories as well. But yes, the launches have been more in the fabric care this time. So yes.
Got it. I'll come back if I have more. Thank you. Wish you all the best.
Sure. Thanks.
Thank you. The next question is from the line of Rishabh Shah from Bugle PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity again. So, as we've read that Jyothy's edge has been created around retail servicing with a personal touch to both distributors and to the retailers. So these distributors and retailers, when they are in bad times in terms of...
Sorry, your audio is not clear. We are not able to understand. Operator, can you just check that line?
Mr. Rishabh, could you please repeat your question and use your handsets only?
Yeah, am I audible now?
Yes, please go ahead.
Yeah. So, as we read that Jyothy's edge has been created around retail servicing with a personal touch both to distributors and to retailers. So these distributors and retailers, when they have bad times in terms of inventory, let's say the payment is not on time and some other problems. So how do Jyothy as a company do help them in such times?
Rishabh, one is we do business on cash, and only if they are able to do that is what. So if you see, we don't give credit in the market, especially you're talking about general trade. Most of our country distributors, we don't extend credit, and we do business only as much as they can actually fund. So there's nothing beyond that we do. But yes, there is a personal touch. There's a relationship that our field staff has built over the years, and they know that we service them well. So that is the understanding. It's all based on trust. So yeah, that's about it. Nothing more.
So next question, how is JYOTHYLAB a different organization than the other FMCG company or competitors in terms of hiring employees, the work culture, and maintaining relationship with these distributors?
No, as Jyothy said, our focus has been to our relationship with the channel, whether it is distributor or retailers, has been very deep. We service them on time in full. Our endeavor is to get the products up to the consumer using the distribution channel. So the service is the differentiator. Second is the value that they get for various brands that we sell and the price that they pay. So this is another aspect. Thirdly, the culture that we have built in the system is in our business, it's a clean sales. So we don't extend credit and overdue, and then all of that in general trade, which is the sizable part of our business. So we don't get into that kind of situation. So the culture remains clean. There is unwanted pressure is not there on these hygiene factors on the sales force for a large part of our business. So I think these are the things which we believe that these are unique propositions from our side to the market.
Okay. Just last question. So as you say, you are spending more on the rural side for some brands. Just wanted to know what was the contribution from the rural area towards our revenue, let's say 3 to 4 years back versus now?
40%, sir.
So right now it's 40%. And what was it 3 to 4 years back?
It remains more or less similar.
Okay. So as you're spending more on the rural side, but the contributions remain more or less similar to our top line.
Yeah.
Okay. Thank you. Thank you so much.
Thank you. The next question comes from the line of Senthil Manikandan from iThought PMS. Please go ahead.
Hi, good evening. Just a couple of questions from my side. First is on the distribution channel mix. So in the initial comments, Jyothy Madam has highlighted that there has been some slowdown in GT that has led to the higher share of other channels and impacting working capital cycle. So if you can share what's the current proportion of quick commerce, e-commerce, and modern trade versus GT over the last year, it will be really useful.
So overall, if you look at the channel distribution in the company, our general trade is roughly 2/3, and the other channels put together would be 1/3. And the other channels constitute modern trade, e-commerce, quick commerce, institutional sales, export, all put together. So that is 1/3 of our total sales. We do not give e-com, quick com, various sub-segment breakup. We do not share that information.
Okay. So in terms of growth, any insight like how the different channels are growing?
Yeah, I mean the entire basket that I just explained, that basket is doing well, is growing, and within that e-commerce, quick commerce, and modern trade, that is doing reasonably well.
Okay, and this slowdown in GT is majorly in the urban markets because of quick commerce, or it's like widespread pan-India level, or we see it?
And largely it is concentrated in urban markets as far as general trade slowdown is concerned.
Okay, sir. Thanks. Second question is on the liquid detergent side. So of late we have been seeing a lot of regional brands also got into this liquid detergent, and they have been offering below 100 rupees on a per liter basis. So in terms of competitive intensity or in terms of differentiation, what the company is doing on the liquid detergent side, it's good that we have doubled the sales Kudos to the management. Just wants to know, with this regional banks entering, how is the landscape panning out?
Yeah, like you said, there are local players, and for us, we'll invest behind the brand. That's the biggest differentiation, Senthil. And when it comes from an organized player, it comes with quality. The brands that we have launched, we have to live up to the name. So the quality that we offer and the price, yes, it has to fetch that price, right? Local players, we don't know, their quality may be good this time, it may be bad next time, but that's how they operate at cheaper prices. Which is a quality product, and for that we continuously will invest behind, behind our brands. Then it is totally up to the consumers whether they want quality or they want to go for a cheaper product.
Okay. Yeah. Thanks. That is from my side.
Thank you.
Thank you. We will take the last question from the line of Vishal Gutka from Ask Investment Managers. Please go ahead.
Yeah, I think just two questions. First, in the HI margin piece, so I think a couple of things are very clear, that movement towards liquid and consolidation of manufacturing activity that you're doing for HI. So clearly, please highlight what are the other things that you're doing to turn around this business operation. And second, on the personal care front, I think during the quarter you also had to provide a trade rate support, given the new prices in the GST regime are lower. So what was the stock that was lying in the trade? You had to provide some support. That was also one of the reasons for declining margins.
So on the first point, HI, there are a lot of actions which are happening, and it's a plan on which we are working. At this stage, we will not be able to disclose what exactly we are doing at the back end. So it's a combination of actions that we are taking on the product subcategory, which is coil and liquid, and then pricing, and then the scheme, and then back end operations. So it's a combination of a lot of factors, and we are working on that. And second, can you repeat your second question, please, sir?
Yeah, for the Margo, since the prices were lower under the new GST regime, right? So whatever the stock that was lying in trade, so you were supposed to provide a trade support because of difference in the prices, whether it's new and old.
No. So when we sell to distributors, they had purchased at 18% earlier, and when the new rates came in, the rate became 5%. So actually, they are having 13% advantage. They are having that input credit which they can utilize. So there was no question of providing any support to distributors.
Got it. Thank you so much. Thank you.
Thank you.
Thank you. In the interest of time, this was the last question for today's conference call. I now hand the conference over to the management for closing comments. Over to you, sir.
Thank you, Dheeraj, and thank you, operator. Thank you all the investors for your continued interest in Jyothy Labs Limited. Have a pleasant evening ahead. Thank you.
Thank you, sir. On behalf of Jyothy Labs and ICICI Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.